kind of rehash where we just were. Let's think about the possibility of people expecting interest rates to be constant over time or relatively constant over time. Okay, so this is you kind of think of it this way. Investors maybe don't know what's going to happen to interest rates in the future, so they anticipate things will probably stay roughly where they are. So what this would mean is, if we think about the yield, the expectation is constant rates. All right, and to be clear, this doesn't mean, when I say expectations are of constant rates, you can kind of think of it this way, all right? If there was no risk premium, interest rates would stay the same. So what this would suggest is, if we had 1-year interest rates today of 3%, then we might expect to have 1-year interest rates 20 years from now of still 3%, okay? So the expectations here are thinking about what 1-year rates might be like in the future. And if we didn't have any sort of risk premium, what we showed in a prior video, right, is if there was no risk premium, interest rates would just be an average of prior rates. In other words, 3 1-year interest rates, so you buy 1-year bonds 3 years in a row, the average of those returns would be the interest rate on a 3-year bond. So this is thinking if there were no risk premiums, what we would expect, okay? In the face of expecting interest rates to stay constant over time, the risk premium will create a positive yield curve, okay? So people expect interest rates to stay the same in the future. 1-year bonds or 5-year bonds will have the same payout today as they will in 20 years from now, okay? But that being said, investors are still going to prefer short-term bonds because of all the things we talked about before, right? Reduced risk, liquidity premium, that sort of thing, okay? So this is what we might expect to see. And we can also kind of imagine scenarios where the risk premium might be higher or lower, okay? So for example, if the Fed announces that it will try to keep interest rates very constant, kind of imagine this being a very reasonable announcement for the Fed to make, that the Fed announces an effort to keep inflation or interest rates very stable. And what we know is inflation and interest rates, the variation in those rates are both relevant to the returns on bonds because of people's risk aversion, all right? Since investors are risk averse, interest rates jumping around a lot will cause investors generally to shy away from long-term bonds, okay? So if they can convince the public of this, that wouldn't necessarily have any change on the expectations of future rates. They're not saying we're going to get, interest rates lower or higher in the future. Rather, they're just going to try to keep it more stable. So what that would do is that would reduce the risk premium. So the difference between the expectations and the reality of the bonds, that's that risk premium there, and that would actually shrink that risk premium down. So the further we are in terms of the yield curve relative to expectations, the bigger the risk premium is, and we actually can suss this out a little bit in the data. We can figure out what investors prefer. Ask investors, survey them. Would you take a sure interest rate of 5% versus a risky one at 6% or something like that? And we can actually get some sort of idea of what the risk premium is at any given moment in time. Okay. So it could be really large, could be really small. You can imagine right now in 2021, the risk premium may be a little bit bigger because we're confused about how things are going to look in the future. So you could kind of imagine that. I'm not sure if that's true, but you can imagine there are certain elements or certain signals that would change risk premiums through time, okay? More uncertainty, bigger risk premium. So people could expect constant interest rates. It would look something like that. People could expect interest rates to go up. All right, so basically you can kind of imagine that this would suggest that people expect 1-year bond rates to go up. So as we look into the future, they're expecting 1-year bond rates to go up, maybe from 3% to 3.5% to 4%. So maybe you get this gradual increase over time. So again, this is expectations, and I cannot stress this enough. This is not what people think the yield curve is, okay? Rather, this is what they expect perhaps 1-year bonds will look far into the future. So if we grab some random data point here at year 20, that's showing us what 1-year bonds are expected to pay 20 years into the future. Whereas the yield curve itself shows us what a 20-year bond pays out today, okay? Because you're kind of mixing two concepts here. And the reason we can do that is, remember that expectations theory suggests that 1-year bonds 20 years from now are just an average, or excuse me, a 20-year bond today is just an average of all the 1-year bonds that occur in the meantime between today and 20 years into the future. So they're very closely correlated with one another in terms of expectations, okay? So the thing to recognize, of course, is if people expect bond rates to go up and we have a positive risk premium, then we're going to get a very sharply positively sloped yield curve, okay? So that risk premium, again, is just these differences between the two. And if expectations are positively sloped and the risk premium is always larger through time, right? It always grows through time. Then what that means is we are guaranteed to have a positively sloped yield curve here, okay? So if you see the yield curve being very positive like this, that tells you that investors expect interest rates to go up, all right? It's pretty likely that that's the case. A third possibility, and here's the one that we care the most about. You don't really hear much about the yield curve in the news until it inverts, all right? So you've probably heard of an inverted yield curve before. These graphs we're talking about here, this is the graph they're talking about in the news, right? So if you're watching, CNN and their concerns over an inverted yield curve, this is literally the type of yield curve that they're referring to. It's just the time to maturity on bonds, okay? So people could expect decreasing interest rates. And this is going to happen a lot. I mean, this is not a unique situation for people to expect decreasing interest rates. That should happen almost half the time, people expecting interest rates to go down. So the thing is, this does not always lead to an interesting scenario here, okay? If people expect interest rates to go down like that, that's our expectations. If that's the expectations on bonds or on bond interest rates in the future, okay? If the risk premium is large enough, this thing could still have a positively sloped or constant sloped yield curve. In other words, when you think about the risk premium and how it grows over time, even if people expect interest rates to drop, you could still get a positive or flat yield curve, okay? So what this shows you is it's really hard for the yield curve to be downward sloping because of the very simple fact that the risk premium grows over time. That tends to lead to a positively sloped yield curve. So the majority of the time, the yield curve is positive, all right? Again, because the risk premium grows over time, even if people expect interest rates to go down, you're still generally going to get a positive yield curve, okay? So what this shows you is if expectations are that interest rates will drop, that alone is not a guarantee that we will have a negatively sloped yield curve. And that also goes to show that if the yield curve is negatively sloped, it's probably because people expect interest rates to go way down in the future. Expectations need to be very sharply negative. So it would need to look something like this. You would need expectations to drop dramatically, okay? Because the yield curve is always based on the risk premium, and that risk premium, grows through time. So you need a very sharply negative expectations curve to result in, this negatively sloped yield curve, all right? So what this would mean is, if you're an investor, you would face options that look like this. If you want to get a 1-year bond in 2021, that might pay out 5%, whereas a 30-year bond in 2021 might pay out 3%. Okay, and what makes that so unique is longer-term bonds have more risk. So all things equal, you would prefer the short-term bond here, okay? So if the long-term bond has a lower interest rate, it must mean that investors are really trying to invest in long-term bonds. And they're doing that because they want to buy the bonds now while interest rates are relatively high before they plummet in the future. So if I expect interest rates to be at 0% 10 years from now, I want to go ahead and get a bunch of bonds now that will last through that period where interest rates are extremely low, okay? So this is a clear indication, if this is what we really saw in the economy, that's a clear indication that people very adamantly expect interest rates to drop. It turns out that when the yield curve goes negative like this, it does actually give us a lot of information about the economy. All right, so let's talk about the yield curve as an indicator of future economic growth. You've probably seen where I'm going with this if you've heard about the yield curve before, so I'm going to go ahead and spill the beans here a little bit. It appears that yield curves can be used to predict recessions. So in other words, when you get that downward sloped yield curve, it seems like that is indicative of a bad economy in the near future. And so we're going to try to think about why that might be the case. So possibility one. If we think about why this might be the case, there's basically two possibilities. Possibility one is that the yield curve inversion is a symptom or simply an indicator of a declining economy. And this is probably the case. This is probably what most economists would agree is happening. So what I mean by this is when the yield curve inverts, that doesn't cause a recession, but rather it gives us an early warning sign of a recession that is bound to happen. So in other words, a recession may be likely to happen 1 year from now, and we don't know it yet, but the yield curve may actually predict that. Again, the yield curve inverting is not causing a recession, but merely is providing a symptom that we can see. All right? It gives us that indication. It's correlated, but not a causal relationship. Okay? And let me explain why this would be the case. Okay? So let's imagine the economy is going to worsen. Okay? If the economy is going to worsen, there's a lot of things we can expect to happen. For example, we can expect the federal government to probably have a bigger debt. They'll be bringing in less tax revenue if the economy is bad. They might end up trying to spend more to stimulate the economy. So that's one thing that would happen, right? You'd get these expected fiscal changes. But we're more interested in what the Fed would do, okay? Because the yield curve, the Fed, you can imagine that these are very connected ideas. So if the economy is going to worsen, what that would mean is people will expect to drop rates in the future. Keep in mind, the economy is not weak right now, okay? But people expect it to get weak. So if people expect the Fed to get, if people expect the economy to be weak a year from now, then they will anticipate the Fed is going to engage in expansionary monetary policies to try to drive down the federal funds rate and in turn drive down the rates of all other bonds and interest rates, okay? So the way this would manifest itself, we can think about in terms of a graph. Let's do two graphs here. So this is our regular supply and demand graph for bonds, where this is price, this is quantity. But let's now break this up into two graphs and think about short-term bonds versus long-term bonds. And so what we would see in normal economic times is people might expect interest rates to go up a little, down a little, roughly stay the same. And because of the risk premium, right? Because the risk premium grows over time, you would end up seeing the price of bonds being higher in the short term than they are in the long run. Okay, so if we think about the relative price, what you would expect to see is that the price for these short-term bonds and the price for the long-term bonds would be a little bit different. Okay, specifically, we would expect higher interest rates here and thus a lower price, right? Higher interest rates in the long term, so thus a lower price in the long term. On the other hand, we would have lower interest rates in the short term, and thus a higher price, okay? So if we suddenly something happens, okay? Let's imagine the Fed comes out and they say something like, we're a little bit worried about the economy right now. That alone can be enough to cause people to have these changes in expectations. So people expect the Fed to need to cut rates in the future. But that doesn't necessarily mean that interest rates are going to be dropped today. In other words, if the Fed comes out and says we're a little bit worried about the economy 1 year from now, that's probably not going to affect the interest rates over the next 30 days, okay? So it wouldn't affect what people would expect for the very short run. But instead, it might make people think about maybe interest rates being lower 2 years or 3 years from now, all right? So the bottom line is this. If people expect interest rates to drop in the future, okay? If people expect interest rates to drop in the future, what that would mean is people would want to go ahead and get long-term bonds now. So if you're an investor, okay, and you expect rates to be lower a year from now, you'd like to go ahead and buy bonds now that will maintain a relatively high rate into the future, all right? So a 10-year bond might look great because you figure if you get a 10-year bond, you will be able to wait out those low interest rates in the future. And when your bond matures 10 years from now, probably everything's back to normal by then anyway, all right? So the demand for these long-term bonds will go up, driving up the price and driving down the yield, driving down the interest rates, okay? On the other hand, okay, if you are choosing to buy the long-term bonds, chances are you're not buying as many short-term bonds. Think about it this way. If you expect interest rates to go down a year from now, buying a 1-year bond today is kind of dumb. If you buy a 1-year bond today, what that means is a year from now, your bond matures and now you got a bunch of money sitting there and you got no good place to put it because interest rates are low, okay? So buying a 1-year bond is going to look kind of dumb. And so what happens is the demand curve goes down and the price goes down as well. So we get two simultaneous effects. The interest rates on short-term bonds go up and the interest rates on long-term bonds go down, okay? And it's not just demand that would be affected here. Potentially, you would see the same effect here for supply, okay? If you're somebody who's issuing bonds, if you're somebody who's borrowing money, for example, you're thinking about buying a house, if you expect interest rates to be lower in the future, you're probably not going to want to get a 1-year, you're probably not going to want to issue a 1-year bond today, okay? Or, I'm sorry, excuse me. If you expect interest rates to go down in the future, all right, you do want to borrow in the future, okay? I'm saying things backwards here. If the interest rates are lower in the future, you do want to borrow in the future, okay? And this is a little bit confusing, all right? Because the thing is, if interest rates are going to be lower in the future, you might think, well, you don't want to get a bond now. But you do, all right? If you expect interest rates to go down, a 1-year bond is great right now, right? If you expect interest rates to go down a year from now and you know you need to borrow money, you're still going to need to borrow money today, but you would prefer to borrow short term, and that way the next bond you issue, you can issue at a low rate, all right? So maybe the bonds right now in 2021 on a 1-year bond, maybe they're 4%, but you're expecting in 2022 they go down to 2%, all right? This is going to mean that it's actually a good idea to go ahead and get this bond, all right? The reason is you want the 2022 bond, but you want to do something today as well. You don't want a 5-year bond, all right? You want a 1-year bond, which enables you to have freed up the option to borrow more money again 1 year from now, okay? So the supply curve shifts to the right as people that need to borrow money choose to borrow short term, okay? I need $10,000 today. I'm not going to borrow for 10 years because I'm going to need to borrow again in the future, all right? And I'd rather borrow new money a year from now than borrow new money like potentially 11 years from now, okay? So I'm going to do a 1-year bond today, borrow a little bit of money to tide me over, and then a year from now, I'm going to borrow a big chunk, okay? So supply shifts to the right as borrowers try to jump on the short-term bonds to free them up to borrow more money in the longer term. Now let's think really long term, all right? Maybe 10 years, 15 years into the future, all right? Right now, in 2021, okay, I do not want to borrow for 10 years or 5 years even, okay? Because I expect interest rates to go down in the future. So if I expect interest rates to go down in the future, I want to wait and borrow a lot of money a year or two from now, okay? So we're going to see a reduction in supply. Investors, all right? Investors really would like to borrow long term because they know that interest rates are going to be low in the future. For the exact same reason, borrowers really don't want to borrow money for the long run right now because they would rather wait and borrow more money in a year or two. So the result, again, is that the price goes down. For short-term bonds, interest rates go up. Price goes up for long-term bonds, interest rates go down, okay? And so I've drawn this with both supply and demand. If you're curious, research shows that demand is the bigger effect. In other words, when we think about people borrowing money or saving money, it turns out that the savers are more affected by expectations, all right? So you can kind of think of it this way and why that would be the case, all right? If I'm thinking about buying a house, maybe I'm just going to buy a house and ignore interest rates, okay? Some people will be like that, right? Some people, if they want a house, they find one they like, they just jump on it. They don't care about interest rates. Whereas savers pretty much always care about interest rates. If you're a saver, you've always got a lot of options, right? You can invest in real estate. You can invest in the stock market. You can invest in bonds from other countries. You've got lots of options. So they're going to be very responsive to changes in the interest rates here. So these demand effects are generally going to be the bigger effects when it comes to expectations, all right? So to get back to our initial point, all right, keep in mind what we're talking about here is that the inverted yield curve can be a symptom of a declining economy. This is not causing a bad economy. It is just giving an indication of a bad economy, all right? It's a symptom. It's not a causal event. So if interest rates are low for the long term, and interest rates are high for the short term, you get that inverted yield curve, okay? Because people are thinking about the Fed's actions. So that's one possibility. And that's probably the more likely of these two possibilities. But there also may be a little bit of column A and column B here. Maybe both scenario 1 and scenario 2 here are valid. So a second possibility is that a yield curve inversion causes a bad economy. Okay? And this has to do with investors that would potentially be sensitive to borrowing money. All right? We just said that investors don't care as much as savers, and that is true, okay? But they still care, all right? When you think about it, the majority of people who borrow money, it's not for homes, it's not for cars, it's not for student loans. The majority of borrowing that happens in the United States is by the government and by big businesses, okay? So like a company like Microsoft, they issue a lot of bonds, they borrow a lot of money, all right? So they're going to care a lot, right? Because they are a profit-seeking industry, or profit-seeking organization. They have tons of economists that they've hired, so they're really going to pay attention to these things. So let's talk about how this could cause a bad economy. If we've got a yield curve that looks like this. So this is kind of like a normal situation here. You know, you've got expectations going down, yield curve going up. By the way, you know, regular people aren't going to think about expectations here. They're just going to look at the yield curve, right? So they're just focusing on that. That's a normal economic period. Interest rates are going to be higher in the future. You know, long-term bonds yield a higher interest rate. This is all very normal stuff, okay? So if I'm looking at this and I'm thinking about borrowing some money, what this tells me is, you know, it's going to be hard to say what's going to happen in the future. Interest rates could go down, they could go up. This is just normal, right? A positive yield curve is because of risk, so this is normal, right? I don't know what the expectations are, so all I see is that, and I don't really get any information from that. In the news, they're not going to talk about it at all. Microsoft, their chief economist, they're not even looking at this, okay? However, when it inverts, when you get a yield curve that looks like this, keep in mind that that is clear indication that people expect interest rates to go way down over time, okay? So let's think about this as a causal effect. If I'm Microsoft and I'm thinking about borrowing money, think about what this tells me. All right? So now we're thinking about this as being causal. So rather than the businesses responding to expectations, this actually creates expectations. All right? So because the yield curve inverts, this shows me the Fed will drop rates in the future. All right? So it's just basically flipping the logic around, okay? So what's interesting about this is, if this is indeed what's happening, then it would suggest that the yield curve is actually not informative, all right? In other words, the yield curve is not a symptom of a bad economy. It's just some random thing that can change through time. So randomly it'll invert, randomly it'll be really positive. And because people have believed this is an economic indicator, it now has its own sort of power to it, all right? So when it inverts, this will actually change behavior. We see this invert. You know, Fox News, CNN, all these news companies are pointing to it and saying this is a sign of a bad economy in the future. And this changes people's behavior. They get pessimistic. And when people get pessimistic, this is what they do. They save more, which is bad for the short run, right? Because saving more is the same thing as spending less. All right, and that, again, that can be okay in the long run, but for the short run, that hurts, right? If people are spending less money today, that will hurt the short run economy. The logic to this is, as an economist who kind of understands these things a little bit, when I see that yield curve invert, I think to myself, the economy will be bad in a year or two, so I better save more in case I lose my job, right? That's the logic to this, okay? So as I spend less, that actually causes the economy to get worse, all right? And that's not the only effect. There's also an effect on borrowers. There's actually two kind of important effects. One is that interest rates will be lower in the future. And that alone might cause you to wait to borrow, okay? This is probably not going to cause the city of Milledgeville to wait, or the U.S. government to wait. It probably won't even affect a company like Microsoft, right? If they need to borrow, they're going to borrow, all right? But this is the kind of thing that really can affect lower level borrowing, small businesses. If you're thinking about starting a restaurant, well, let's wait a year. Let's wait a year and see what happens, okay? So if you expect interest rates to be lower in the future, you would rather borrow in the future. So you get this substitution effect. People don't borrow today, and instead they borrow in the future. Okay? Less borrowing today hurts the economy. All right? Less borrowing today hurts the economy. That means a reduction in housing, right? Fewer houses will be built, fewer houses will be sold. People won't go to college as much because they'll be scared to borrow, they'd rather wait, and you can go down the list. Okay? So that alone is bad for the economy. But the other thing that happens is when the yield curve inverts, remember that expectations of the economy, that alone is a driver of the desire to borrow, right? The supply of bonds. And so the other thing is they expect a bad economy. So, for example, if you're thinking about borrowing money to start a brewery, okay, there's two similar but different reasons why you would not want to do that today. One, you don't want to borrow money to start a brewery because you think interest rates will be lower in a year. So you'd rather borrow then. And two, you expect the economy to get worse, so you might not have very many customers in the future, okay? So when you think about this, you recognize there's a lot of things wrapped into this decision. Expectations can drive the economy. And if people get pessimistic, that affects everyone, okay? If people get pessimistic, that affects you. That affects everyone, because optimism is a public good. It's non-rival. It's non-excludable. There's nothing you can do to stop somebody from enjoying the optimism of everyone else. But when it flips and it goes pessimistic, you might lose your job even if you remain optimistic, all right? So this can be causal, all right? We have become so ingrained to thinking that the inverted yield curve means something that it now does because it changes expectations. So, what's the track record here? if we think about yield curves through time, how often does that suggest that the economy will indeed go into a recession? Well, the track record is pretty strong. All right, so out of the last 8 recessions, all were predicted by an inverted yield curve. In other words, if you look at all the recessions that have happened back since 1950, all right, all the recessions since 1950, all of those had an inverted yield curve before the recession. And the time periods here are between 7 to 19 months. All right? In other words, between 7 and 19 months prior to the start of the recession, we had an inverted yield curve. And this actually just happened back in summer of 2019. Yeah. The summer of 2019, we had an inverted yield curve. It was a big deal. Everybody was talking about it in economics. People said it's going to predict a recession. All right? And it did. All right? Now, would that recession have happened if we hadn't had COVID? Who knows? All right? But you can check the box. Yet again, the yield curve predicted a recession. However, there are some false positives. Okay? However, there were 3 cases of an inverted yield curve with no recession. All right, so if we take this literally, what this would suggest is an inverted yield curve is a necessary but not sufficient condition for recessions, and that's been true for the last 70 odd years. So there's kind of a famous economic saying on this that the yield curve has predicted 11 of the last 8 recessions. So there are some false positives, okay? Now, some of you have taken some statistics classes, 11 is not a very big sample size. We've had 11 yield curves. 8 of those have predicted recessions. Is that meaningful? From a statistical standpoint, it's kind of hard to say that that is a big deal. In other words, recessions come about every 7 or 8 years on average anyway. So on average, there is a recession in the next 3.5 years. Okay, at any given moment, there's like a 50-50 chance there's a recession in about the next 3.5 years. So if you just pick 11 random years and said, these are just random starting points that I'm going to choose, it's not impossible that you would get recessions 8 out of 11 times, right? It's not impossible that this could be pure randomness. But we have become so accustomed to using the yield curve to predict recessions that I think that second scenario of causality is indeed bearing out. People are so connected to the yield curve. People are so convinced that the yield curve causes recession that at this point, it probably does.